And welcome to the Aaron Katsman Show. I'm your host, Aaron Katsman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please go ahead and subscribe to both the YouTube channel and to the podcast. And if you think someone may find this of interest, why don't you go ahead and hit the share button and you can share it with them as well. So I had a meeting earlier today and we were speaking about sort of the philosophy of how I would invest the money. And the prospect started out by saying, well, I always like that when I get my ears, my antennas always going up when they heard that like semiconductor stocks and AI stocks are hot, and that's what she wanted. She was told that's what she should have in all of her portfolio. So I prodded some more, and it turns out that it was like a cousin of hers told her that that's what, they knew, and that's what they should invest all of the money in. So I then spoke, and forget about, the asset allocation and how much should be in fixed income. That part's not relevant. But what I said is that there is no, and I say this all the time, there is no best portfolio. Investors have to understand that. There is no best. What investors should really shoot for is reasonable. Okay, a reasonable portfolio. Because what is the best portfolio? You only know the best afterwards, right? If it's the best based on previous results, previous return, who knows what's that going to do in the future? There's no way to know, right? But reasonable is where you have a diversified portfolio and you're basically keeping up with the broader market. Again, the stock part of the portfolio, I'm not getting into fixed income or anything like that, okay? But to try and have the best is a fool's game. You're not going to get there, okay? What's important is to build a reasonable, diversified portfolio, which generally, again, past results is no indication of future returns, but generally outperforms chasing top performers. Because in a diversified portfolio, you're going to minimize extreme risks, you're going to smooth out market volatility, and you're going to prevent sort of the costly emotional mistakes of panic selling. Diversification ensures your long-term wealth isn't devastated when last year's winning assets inevitably stumble. They fall, for those who don't know what stumble means. They get smashed, okay? There's what's called the winner's curse and reversion to the mean, right? Top performing assets rarely stay at the top forever. Historically, assets that perform exceptionally well in one period often underperform in the next as valuations stretch and market conditions shift. When you buy a top performer after a massive run, you're often buying at the peak, right? You're buying high. Chasing these returns means you are primed to absorb the losses when the assets drop back to its average, right? Keep in mind the goal here is to buy low and sell high, not to buy high and sell low. If you've ever seen one of those charts, like an asset table, an asset return table, you'll see it's like a yo-yo. If you follow, right? 1 year US large cap stocks are the best performers. They could be for a couple of years like they've been. But then all of a sudden out of nowhere, the worst performers, like maybe small cap stocks, will shoot to the top or start working their way up. And the following year after that, they're the top performer. And then all of a sudden you'll have emerging markets, and then you'll have mid-cap stocks, and then you'll have developed international. It's like a yo-yo, right? The top performing asset is not the top performing asset forever. And that's where people also get stuck with the whole move to, just put your money in the S&P 500. Well, the S&P 500 has had a nice run, but for those uninitiated, for like the last, 16 or 17 months, it has not been the top performing asset. Historically, it's not the top performing asset. It's not terrible to put your money in, but if you diversify your portfolio, if you have some exposure to small cap stocks, mid cap stocks, international, over time you're going to cushion the volatility to a certain extent. Like I said, there's certain assets which always will have good years and have less good years or bad years, and when that happens, there are other assets based on valuation which move up. Like I said, it really is like a yo-yo. Today's top performer, chances are, will not be next year or the following year's top performer. In fact, it'll probably drop to the middle or to the bottom third, or bottom half. That's just what generally happens. Lower volatility and smoother compounding. Trying to pick only the best performers induces wild swings into your portfolio as well, right? It's the anti-steady. It's the anti-slow and steady, right? Keep in mind that if your portfolio drops 50%, you know what that means? It means you have to double your money. You have to have a 100% return just to break even. A reasonable diversified portfolio limits these brutal drawdowns. It doesn't eliminate risk, right? You can still lose lots and lots of money when you have a diversified portfolio, but the brutal drawdown generally is limited. By balancing assets such as mixing stocks, bonds, real estate, you achieve a smoother, more reliable compounding of your annual growth rate, which is also important, right? People don't necessarily, even though at the end of the day, you get from point A to point B, and point B is, let's say, over decades, significantly higher than point A, right? This is point A, point B is somewhere over here, right? A lot of people would rather get there, in a steadier fashion than this, right? They rather sort of be slow and steady as opposed to the tremendous volatility. Chasing top performers usually means concentrating your money in a few hot stocks or sectors, right? Some of you might be way too young to remember, but I remember, right? If you invested heavily in one booming industry, say technology, right, in 1999 or early 2000, and that blows up, for example, your entire portfolio is just devastated, right? A reasonable approach, that what I am, speaking about, spreads risk across hundreds of different assets, ensuring that one, bankruptcy of a high-tech company or one slaughter of an entire industry doesn't impact your whole portfolio as much, right? You don't get that big hit. And for just, people say, well, but over time, right, that's going to do way better. Well, maybe that's true, but people psychologically have an aversion to losing money and have a bigger aversion to losing 50% of their money. Just keep that in mind. Investors who chase top performers often fall victim to a very poor timing. They buy high out of greed because everything's moving up. I got FOMO, right? I don't want to miss out. And they sell when things start dropping at the bottom, right? Now, hold on. Oh, it'll come back. And then all of a sudden it doesn't come back so fast. And then, oh my gosh, and they get out of it. A diversified, sensible portfolio, reasonable portfolio is easier to hold during market corrections because you know that your overall strategy is built to weather the storm. Sticking to a plan is the single biggest predictor of long-term investing success. How many times have I said that, right? And here's sort of the punchline, right? Rather than trying to find the needle in the haystack, a reasonable portfolio, right, a couple of broad market index funds simply buys the whole haystack, right? You're not looking for the needle. You just buy the haystack, buy the market, right? And it's covered. Over long periods, a vast majority of individual stocks underperform the overall market average. By holding a diversified portfolio, you guarantee that you capture the market's long-term upward trajectory without the stress of stock picking. And I say sector picking as well. People will say, well, I'm a believer, as you know, in ETFs and biotech stocks, but we'll leave that for a second, right? We'll put that on the side for another podcast. Broad-based. I'm not a fan at all of sector ETFs. Why? Because to me, investing in a sector is going against the whole concept of buying indices, right? You're buying a sector. Well, I know that this sector, I know that semiconductors are going to outperform utilities or financials or whatever. And the data says, right, that you're not going to do it. Why do people invest in indices for the first off? Because over 90% of financial professionals can't beat the index they're matched up against, right? So if that's the case, why pay more when you can pay less and just buy an index? So if you're going to say, no, I know that, AI and robotics are going to outperform the broader markets, you're already making that bet. And as we've said, statistically, you're going to fail. You're going to lose that bet. So why do it? Food for thought. You've been tuning into the Aaron Katsman Show. We speak about your life, your money, and your investments. If you like this content, why don't you go ahead and, first of all, subscribe to both the YouTube channel and to the podcast. If you like it, then go ahead and share it with somebody who might find of interest as well. Okay? Thanks so much for tuning in, and we'll speak to you soon.